So you want to be in business for yourself, you want to have partners and be in business together, you want to have shareholders. So what kind of entity do you want to be? What are the registration, filing requirements of each of those entities? What are the tax implications of those entities? I'm here today to help you understand those things that you need to know about as you begin your new business. All right, so today we're going to talk about the different kinds of entities that exist. We're going to talk about how you form those entities, register those entities. We'll talk about some of the liability concepts related to those entities, how or what kind of fringe benefits that you can offer within those entities, how those entities are taxed, that information, how it's going to flow through to your tax return and the implications related to that. And then we'll also talk about some of the ongoing compliance filing requirements that you're going to be subjected to as you start your new entity. So first, a quick disclaimer, this is a general conversation about the different kinds of entities that are out there, trying to help you understand how those things are formed and taxed so that you can make more informed decisions. My conversation today is surrounded by the federal and state filing requirements and the state formation requirements for those entities. So you may have other states that you're working in and need help in. I'd suggest that you seek your trusted advisor in those states. You're going to have similar types of registration requirements in those states, but the references that I'll make today are specific to Tennessee. There are a lot of things to consider as you decide what kind of entity you want to be. How easy is it to form that entity? How complex is that? What are the legal liability concepts related to the different kinds of entities? Do we have more than one owner in that entity? Do we have an interest in transferring ownership of the company as we go along down the road? Do we want to reward our employees for participating in the company and transfer some ownership to them somehow? Do we want to raise capital? Do we have money that we need to get our business started? Are we allowed to offer fringe benefits? And are those fringe benefits tax deductible for our businesses? And then each of these entities has different tax implications to the individual owner. So we want to talk about those tax implications as well. These are the different kinds of entities that exist: a sole proprietor, partnership, S corporation, C corporation. The first three entities listed there, the sole proprietor, partnership, and S corporation, are all what we call flow-through entities. Basically, the partnership and S corporation are federal reporting entities that will report the income to the federal government, but then the income of the entity flows through to the individual shareholder or partner or member of that entity. So those are all flow-through type entities, and the tax is borne at the individual level. We'll see that when we get into the taxation side. On the C corporation side, it's its own tax-paying entity at the federal level. It will pay a tax on its net income of the business. So each of these concepts need to be considered when we talk about our entity choices. The easiest entity to set up is a sole proprietorship. We move into more complicated structures like the partnership, the LLC, and then more complicated, the corporations, whether it be a corporation that's elected to be treated as an S corporation or a C corporation. So how do we start a sole proprietor? And then what are the other registration requirements related to being a sole proprietor? And then we'll compare and contrast the sole proprietor registration activities to the partnership, to the S corporation, and then the C corporation. You'll see some similarities between all of these registration filing requirements between the entities. So it's a privilege essentially to do business in your state or local jurisdiction, and those jurisdictions require that you register to do business in those areas. That puts you in line for paying taxes in those areas as well. So that's essentially the registration requirements. It's a privilege to do business, and they require you to register. As a sole proprietor, you're going to register with your city or county. If your business is located within the city jurisdiction, It is also within the county jurisdiction, so you'll be registering for 2 local business licenses, one at the city level and one at the county level. They are 2 separate, distinct taxing jurisdictions, and so generally you have to get your registration from each of those jurisdictions. That's your local business license. If your license happens to be issued by the state through a professional designation, whether it's engineer, realtor, CPA, doctor, those professional licenses serve as your local business license, and so there's not a requirement for you to have a local business license under that scenario. So as a sole proprietor, you've obtained your business license, you're in business. Now you can operate your business and generate revenues. I'm going to recommend that you start a separate business bank account to keep up with those business records. So all of the transactions related to the business, the revenues, credit card deposits, check deposits, cash deposits go into that bank account. Expenses get paid out of that bank account. So now you have 12 months of bank statements that basically summarize all of the activity for the business. It makes life much simpler. If you happen to need a credit card or want a credit card, that's fine too. Designate a credit card that you use exclusively for business. The business bank account pays the credit card, so now you've got 2 sets of documents, a bank statement and a credit card statement, that make up the business transactions for the sole proprietor's activity. If you're going to have payroll, W-2 employees, you need to obtain a federal ID number from the IRS. That federal ID number would then be used to register with the Tennessee Department of Labor and Workforce Development for your state unemployment filing requirements. You can get a federal ID number even if you don't have payroll. Be careful in your application for that federal ID number though. If you tell the IRS you're going to have payroll, they're expecting you to file a payroll tax return, and if you don't file that payroll tax return, then you will be charged penalties for failure to file. So that registration for the federal ID number happens on a form SS4. You can go to irs.gov, look at their forms and instructions tabs, and see the instructions for the SS4 and the form itself, and you'll see where you tell the IRS whether you're going to have payroll or not. In addition, in Tennessee, if you're going to be selling product or working on tangible property, you are going to be subjected to sales tax. Basically, you'll collect sales tax from the purchaser, and then you're remitting that sales tax on a regular basis to the Tennessee Department of Revenue. You have to register in order to obtain a sales tax account number. When you register for that sales tax, you will also receive a resale certificate, is what it's called, and basically allows you to purchase goods free of sales tax because you're intending to resell those, and you'll be collecting and remitting sales tax on those goods to the Tennessee Department of Revenue. That's how you start a sole proprietorship. It's very simple, cost effective. It doesn't require a whole lot of additional cost. If you want your sole proprietor to operate under the LLC umbrella, the limited liability company umbrella, you'll have to start by registering that LLC with the Tennessee Secretary of State. That registration document is called Articles of Organization. Articles of Organization are specific to a limited liability company. On that, you would tell them how many members there are in that LLC. In this particular case, the LLC is going to be a single member LLC. With that Secretary of State designation, they assign you a Secretary of State account number. Following that, all of your activities and registrations are exactly the same for the sole proprietor LLC as they are for the sole proprietor. You'll obtain your local business license. You'll open a business bank account. If you're going to have payroll, you're going to register and get a federal ID number, and also register with the Tennessee Department of Labor and Workforce Development. In addition, you'll have your sales tax registration as well. Now, it may be more than just you going into business. You may have a partner who you want to operate this business with. That can operate as a partnership, or you can form as an S corporation, or you can form as a C corporation. So let's talk about the partnership side first. This is more than one person going into business for a profit motive together, and that partnership will have its own federal ID number. It is an agreement between two parties that we're going to operate for this profit motive, and this is going to be how we operate. So I recommend that you document that agreement while you're getting along. In a partnership agreement, in addition, you have an operating agreement. If you're 50-50 partners and you're at odds with one another, who's going to have the deciding vote to basically move that partnership forward in a direction? The operating agreement is going to outline that information. So you all agree to that on the front side, get it documented in writing. In addition, that document provides the terms of any dissolution of that partnership. So if the partnership's going to break up for whatever reason, we want to have that agreement in writing while we're all agreeing on the partnership and the concept. Once that partnership's in place, your registration requirements are exactly the same as they were for the sole proprietor. You're going to obtain a local business license. In the partnership case, you will have to obtain a federal ID number regardless, because it is its own tax reporting entity at the federal level. And again, to respect the entity structure, you're going to open a separate bank account with that federal ID number. And if you'll have payroll, you'll be registering with the Tennessee Department of Labor and Workforce Development, and also registering for sales tax, if that's applicable, with the Tennessee Department of Revenue. So you can see each of the formation requirements, or the registration requirements, is basically the same for each of these entities. In the event that this partnership is going to operate as an LLC, the LLC needs to first file its articles of organization with the Tennessee Secretary of State. And it will operate under the limited liability company rules, the statutory rules of the state. If it's just a general partnership, there is no Tennessee Secretary of State registration that's required. Some people recommend that you do register it anyway. So let's move on to the S corporation. We've got two ways that we can be an S corporation. We can register as an LLC at the state level, filing our articles of organization, or we can file at the Secretary of State level and file articles of incorporation and register as a corporate entity in Tennessee. Regardless of that, you're going to have those articles filed. If you're filing as a corporation, you're going to have stock certificates being issued in exchange for cash or equipment, if that's the case. You'll have a board of directors, and you're going to need to retain and document the minutes of the various meetings that the board of directors has. Those first four requirements are if you're forming as a corporation. You can form as an LLC and elect to be treated as an S corporation. There's a special election form that has to be filed. I've identified here in item number 7. The LLC requirements for stock certificates, board of directors, minutes of meetings is not as heavy or burdensome. So many folks like that limited liability company structure because of its ease of administration. But again, the S corporation is going to be its own entity and will need a federal ID number from the IRS. It will need to register for its business license at the local level. And then it will use that federal ID number for its business bank account, payroll registration with Tennessee, and sales tax registration with Tennessee. Let's move on to the C corporation. If we're going to be a C corporation, we would want to file articles of incorporation at the state level Again, we're going to have stock certificates issued in exchange for cash or equipment or combination thereof from the stockholders. Board of directors will be named, and there'll be minutes of meetings that need to be retained. That corporation, again, is going to get its federal ID number, its local business license, open its bank account, register for payroll, and register for sales tax. So essentially, outside of the local and federal registrations, there's a few nuances for those entities as you either file articles of organization for the LLC or file articles of incorporation for the corporation. At the federal level, if you want to be treated as an S corporation, there is an election form that's required to be filed with the federal government so that they recognize you as an S corporation. So that's basically the formation of those entities and how you're going to keep up with those business records. Let's talk about the other consideration called owner liability. One of the concepts that exist is if we are in one of these entity structures, we limit our liability exposure. So let's talk a little bit in concept about liability exposure. First of all, the operating business is going to have some sort of a business insurance policy. The limits of that policy will be, say, $500,000. In the event that something happens and that there's litigation involved, the first pool of money and resources that is attacked is essentially the insurance. If the litigation exceeds the insurance amount, then the personal owners are at stake for the extra beyond that insurance amount. And then the question becomes, how do we protect our personal assets from this business adventure, this business investment that we've made? The concept is that our limited liability entities will protect our owners, and essentially their liability risk is limited to whatever their investment in that entity was. As a sole proprietor, liability exposure is essentially unlimited. As a general partner in a partnership, you are also exposed to unlimited liability for the activities and actions of that partnership. If you're a limited partner in a partnership, the concept is you would be limited to your investment in that partnership. In other words, if the partnership went belly up and you invested $10,000 in it, you lost $10,000. So those are the concepts related to owner liability. I would encourage you to speak to your legal counsel about the concept of providing personal services for those limited liability type entities. My example that I give is essentially you're driving the 18-wheeler down the road that is owned and operated by the sole proprietor LLC, the LLC partnership, the S corporation, the C corporation. Each of those limited liability entities is designed to try to segregate your personal assets from the business assets. But if you're the one that owns the LLC and you're the one driving the truck, I would suggest to you that the litigation involved in that accident will include not only the corporation, but also the driver of that vehicle. So you would still have liability exposure if you're the one operating that vehicle, performing that surgery perhaps, even if you're operating as an LLC. So I'd encourage you to talk to your legal advisors about that concept. You'll want to make sure that you have insurance sufficient to protect you from that personal liability exposure as well. Okay, so we talk about what kind of fringe benefits can be offered by these different kinds of entities. Well, each of the entities can have group health insurance for its employees. If that health insurance plan qualifies, can establish health savings accounts for its employees. If it wants to offer a flexible spending account in lieu of the health savings account, it can do that. And there are also many different kinds of retirement plans that are available to all of these entities. So a sole proprietor can have the health insurance, the health savings account, flexible spending account, and retirement plans, as can the partnership, the S corporation, and the C corporation. The issue, and we'll go into this when we get into the taxation of these entities, is going to be where these items are deducted, because it will differ by entity as to where the group health insurance for the owner is deducted versus the group health insurance for the employees. The health savings account contribution for the owner as opposed to the health savings account deduction for the employees and subsequent contribution to the health savings account. The withdrawal of those funds for flexible spending accounts from employees' paychecks. The retirement plan contributions that the owner-employer basically elect to have deferred and the company match for those retirement plans. Each of those has different tax implications for some of these flow-through entities, and so we'll talk about those when we get into the taxation side. Let's establish some baseline understanding, because we're talking about three different types of entities that are flow-through entities. So I need to basically make sure that we're on the same playing field for how those flow-through entities will impact your individual tax return. So our sole proprietors, our partnerships, and our S corporations will all end up flowing through your individual Form 1040, each of them on a different form, but the income or loss from those entities will flow through on your individual tax returns. So we start with the concept on the individual tax return. We have income, our gross income, after our business deductions. So this will be our total income for individual income tax purposes. From that number, we will deduct items for AGI, for adjusted gross income. Income minus the deductions for AGI yields a number called adjusted gross income. Adjusted gross income is a number where there's a lot of phase outs that essentially are established based upon the adjusted gross income. From our adjusted gross income, then we deduct items from AGI. If you itemize deductions, that's a deduction from AGI. If you take the standard deduction, that is a deduction from AGI. AGI minus those standard deduction or itemized deductions is going to equal our taxable income. So this is our federal taxable income. From our federal taxable income, we look at the federal tax tables, married, filing jointly, single, head of household, and we calculate our federal income tax. We subtract credits from that, and then we look to a different schedule to obtain what's called your self-employment tax. That self-employment tax is going to be based upon the net self-employment income that flows from that business. It is generally one of the most expensive taxes for our small businesses, and so that's the number that we need to plan for, because it can get very expensive for our small businesses, and it's an unexpected number sometimes in these flow-through entities. So our tax minus our credits plus our self-employment tax minus some other credits will end up equaling our total tax that we owe. So today we're going to talk about income and how that income gets affected by those individual entities and the related deductions for AGI that come through those entities eventually affect our adjusted gross income and our tax. So the kinds of income that are going to flow through the 1040 are W-2 wages. You're a C corporation shareholder, you're an S corporation shareholder, you receive some W-2 wages. So the W-2 wage number is going to be our first item that we look at. Next, we're going to focus in on these entities and the net flow-through income, or net self-employment income in the case of a sole proprietor. So those flow-through incomes is where we'll focus our energies. But understand the W-2 and the flow-through income result in the total income, along with these other sources. The things that we'll be talking about today are deductions for AGI. For our sole proprietor partnership, it's going to be our health savings account deductions. Half of our self-employment tax is deductible for AGI. Our retirement plan contributions that we make elective deferrals that we make are going to be deductible for AGI. If we have self-employed health insurance, those are deductions for AGI. And then our individual retirement account deductions. So let's go back to the formula of income minus deductions for AGI. So focus in on this deductions for AGI because half of our self-employment tax, our elective deferrals for the retirement plan contribution, our self-employed health insurance, our health savings account are all deductions for AGI. So we are going to be saving federal income tax on those deductions. The piece I need to make sure I land in your brain is that many of those deductions are not deductible for your net self-employment income as a sole proprietor, as a partner, and as a S corporation shareholder. So you don't get to deduct those for net self-employment income purposes. Go over that in a little bit more detail, but make sure you hold on to that concept. So how are these entities taxed? Basically, we're going to be talking about revenues minus expenses equals net income amongst all three of these entities. So what are revenues? What are expenses by each of these entities? Well, revenues are going to be gross revenues from all sources. This includes cash, checks, credit cards, and bartering. If you were bartering for your business activities, that is technically revenue that should be reported on your tax return. So it's all sources of income that you derive from your trade or business activities. As far as your expenses, your deductible expenses are all ordinary and necessary expenses that you paid or incurred in carrying on the trade or business. You don't get a deduction for personal living or family expenses, only trade or business expenses. So let's go through the conversation of how these entities are taxed. As a sole proprietor, you're going to be determining your revenues minus your expenses, and that information is going to be reported in detail on your Form Schedule C that's included in your Form 1040. That Schedule C will arrive you at a number called net income. That net income is subject to self-employment tax. Self-employment tax is Social Security and Medicare tax, and you as the employer and employee combined get to pay 15.3% of your net self-employment tax. And the math is a little bit different. I don't want to go into those details, but for big picture purposes, 15.3% of your net income will be your self-employment tax. The self-employment income is then included in your total income minus your deductions for AGI, minus your deductions from AGI to determine what your taxable income is, and then your federal income tax is calculated on that. If you happen to be an LLC in Tennessee, Tennessee taxes those LLCs on a Form 170, and they call it a franchise and excise tax. That franchise tax and excise tax for a operating sole proprietor, say someone who's in the service business, is going to be primarily limited to the franchise tax. The excise tax, our operating sole proprietors get to exclude self-employment earnings from the excise tax. So anything that's self-employment income related, there is no excise tax. The conversation then, what is subject to excise tax, is going to be those other profits, sales of equipment, sales of property, long-term capital gains. Those items are going to be subject to a 6.5% excise tax. So on a sole proprietor, we've got our revenues minus expenses equals net income. Amounts that are paid to or on behalf of the owner are not expenses for our sole proprietors. So the sole proprietor pays him or herself wages or treats this distribution to them as this is my pay for my services. That is not an expense of the sole proprietor. Sole proprietor reports revenues minus operating trade or business expenses. advertising, rent, utilities, etc., to arrive at the net income. I said amounts paid to or on behalf of the owner. That includes our fringe benefits. So our health insurance premium that we pay as a sole proprietor is deductible as self-employed health insurance, but it's only deductible for federal income tax purposes. It is not deductible for self-employment tax purposes. Same thing for our elective retirement deferral contributions and the employer match contributions on our sole proprietors for the sole proprietor's elective deferral. That retirement contribution the sole proprietor chooses to make for him or herself is not deductible for the net self-employment income, but is deductible for AGI and basically reduces the amount of income exposed to federal income tax. If we're going to be a sole proprietor LLC, those are exactly the same results. Our health insurance and our retirement contributions for our sole proprietor are not deductible for net income, for self-employment income. Our health insurance and retirement contributions are deductible for AGI and result in less of our income being exposed to federal income tax. So if you're in the 22% tax bracket at a federal income tax level, the health insurance premiums that you pay, the contributions that you pay, will save you 22% in tax. That's the simple math. So let's look at an example for our sole proprietors. Pretend we've got revenue of $150,000, trade or business expenses of $80,000. That generates a net income for that sole proprietor of $70,000. The sole proprietor took distributions of $60,000 out of the company to pay essentially their personal expenses. They're going to be taxed on $70,000 of net income as an owner. Not what they took out of the business, but what the revenues minus the expenses are of the business. So the owner and entity are paying tax on the $70,000 net self-employment income. So let's move to partnerships. Partnerships at the federal level are a reporting entity. They'll use a Form 1065 to report the net income of the partnership. The net income of the partnership is then reported out to the individual partners on a Form K-1 for their respective part of that net income. Following that, the individual partners will then include that respective net income on their individual tax return. The individual tax return will then calculate the self-employment taxes associated with their percentage of the net income along with the federal income taxes. Partners should not be receiving W-2 wages. They are not employees of a partnership. They are partners, owners who receive distributions or perhaps guaranteed payments, or a combination of both. A partnership operating as a limited partnership or as a limited liability company in Tennessee will be responsible for also filing a Tennessee franchise and excise tax, where they report the franchise and pay franchise tax on a rate of 25 cents per hundred. And if they have income other than self-employment earnings, they'll pay an excise tax at 6.5% of the net income. So partnerships revenues minus expenses equals their net income. Their guaranteed payments that are made to the partner are expenses of the partnership, thus reducing the net income that gets reported amongst the partners. Distributions to the partners are not an expense of the partnership. Guaranteed payments are a situation where you might have a working partner and an investment partner, and that working partner says, look, I need a living wage because I'm working 40 to 80 hours in this business. I want to make sure that I can pay my bills at the family level, so I want a guaranteed amount to be paid to me for my services. Those are guaranteed payments. Typically, those are documented within the partnership agreement. For the partnership who's offering fringe benefits to the partners and to its employees for health insurance, the health insurance premiums that it pays on behalf of employees is deductible by the partnership as an expense. It's also deductible for the partner's portion of the health insurance premiums. However, the partnership reports the amount of the premiums as a guaranteed payment to the individual partner. So the partner then picks that income up. In addition, they get to deduct that self-employed health insurance premium on their individual tax return. It's essentially a wash from a federal income tax perspective for the partner, but it effectively puts the partner at the same level as the sole proprietor, because the health insurance premiums, while deductible for federal income tax purposes, will result in self-employment tax being owed on the guaranteed payment. The retirement plan that the partnership may have typically is going to be reported out as either a distribution to the partner or as a guaranteed payment to the partner, because the partner will then report that retirement contribution for the partner as a deduction for AGI on their individual tax return. The other contributions that the partnership makes for the employees of the business are deductible expenses of the partnership. So again, the individual who is a partner who receives health insurance from the partnership will be allowed to deduct the health insurance premium that the partnership paid as a deduction for AGI, along with the retirement contribution as a deduction for AGI. But they also will be picking up that money as a guaranteed payment to them on their individual tax return. So in our partnership example, where we have 50-50 working partners, $150,000 in revenue, $80,000 in expenses, net income of $70,000. The respective partners will report their half of the net income regardless of the distributions they may have taken out of the partnership. In a working partnership where we've got a working partner and an investing partner, the working partners requested a guaranteed payment of $30,000. That becomes a deduction for the partnership, reducing the net income of the partnership to $40,000. That $40,000 is then split between the two partners 50-50, with partner A, the working partner, receiving the $20,000 net income allocation from the partnership plus the $30,000 of guaranteed payments. They're paying tax on $50,000, where the investing partner is paying tax on $20,000. When we move to the conversation about S corporations, we begin to see a couple of differences on how those fringe benefits get taxed. So our S corporation is going to be, again, a reporting entity, but it will use a Form 1120-S to report the net income of the business. It doesn't pay tax at the federal level. It just reports the net income of the business and then gives the shareholders information about their respective percentage of the income of the business. S corporation shareholders should have W-2s for their wages and may also receive distributions of profit from the S corporation. So those S corporation shareholders will report their respective part of the net income on their individual tax return, as well as the W-2 wages on their individual tax return. The distinction here between our sole proprietors and our partnerships is that our S corporation shareholders' pass-through income, their percentage of the net income, is subject to federal income tax. It is not subject to Social Security Medicare tax, that self-employment tax piece that we referred to earlier. So that is one distinction within the S corporation world, that you get to avoid that self-employment tax on that profit that passes through from the S corporation. The downside in Tennessee is if you're an LLC or an S corporation operating as an S corporation, or a corporation operating as an S corporation, that entity is going to be subject to franchise tax and excise tax. The 6.5% excise tax will be on the net income of the S corporation. Depending on if your net income of the corporation and the wage base of the individuals, it may make sense to pay out the remaining income in the form of a bonus to those shareholders and offer 2.9% Medicare tax as opposed to offering 6.5% excise tax to the state. In other situations, it makes more sense to leave the net income in the S corporation and pay that money out in the form of distributions. Each tax situation is different, and each year for an entity is different as well. So make sure you review those with your advisor to determine what is the best course of action for you. Our S corporation's revenue minus expenses, the wages that we pay our shareholders, are expenses of the business, thus reducing the net income of the business. Any amounts distributed to the shareholders are not expenses of the business. When it comes to the fringe benefits of an S corporation, they have the same ability to have a group health insurance policy for the shareholders and the employees. The issue is that the shareholders who own more than 2% of the stock are required to include that health insurance premium that was paid on their behalf as federal wages in box 1 of the W-2. The differential here between a sole proprietor and a partnership is that this health insurance premium that is paid by the S corporation will avoid Social Security and Medicare tax, whereas the sole proprietor and partnership will not. So there's a small edge to having that health insurance plan offered through an S corporation as opposed to the other two entities. When it comes to retirement plans, the employees participate in those retirement plans through their W-2 withholdings, and so it effectively becomes a deduction of the S corporation along with the company match for those retirement plans. While those don't avoid Social Security and Medicare tax, they do avoid federal income tax. So our individual shareholder will pick up their W-2 wages as income. In addition, they're part of the net income of the business, and then they will in turn deduct the health insurance premiums that were paid on their behalf and included in box 1 of the W-2 as a deduction for self-employed health insurance. And then the retirement contribution that's made on behalf of the S corporation is included as a part of the W-2 deduction, thus avoiding federal income tax. As we put numbers to this, the S corporation's revenue in our 50-50 partnership were $150,000, expenses of $80,000. We paid W-2 wages of $30,000 apiece. The company then has to pay half of the payroll taxes, Social Security, Medicare payroll taxes, plus state unemployment and federal unemployment taxes on those wages. They get to deduct those expenses as expenses, and so the net income of the S corporation becomes $5,000 after those deductions. So in the end, the owner A and owner B will pick up their respective W-2 of $30,000 plus half of the net income of the business, $2,500, for a total of $32,500 for each of them on their federal income tax return as reportable W-2 wages or flow-through income. So the total income that they're going to be reporting is $65,000 combined because the company paid the $5,000 of tax related to their wages. The S corporation, where we have a working shareholder and a non-working shareholder scenario, reflects this. Revenues minus expenses minus the W-2 wages for the working shareholder minus the payroll taxes related to that gives us our net income of the S corporation at $37,500. The owner A then reports the W-2 wages of $30,000 plus half of the net income of the flow-through entity, or $18,750, for a total of $48,750. Then the investing partner reports their half of the flow-through income of the business. So a total income is reported as $67,500. That's $2,500 less because of the payroll taxes that were paid in scenario 1 versus payroll taxes paid in scenario 2. So that flow-through income of $37,500 is not subject to Social Security and Medicare tax at the individual level because it flows through from an S corporation. So it will avoid the self-employment tax at the federal level when it's paid out in the form of a distribution. The downside in Tennessee is we have a 6.5% excise tax that gets charged on that $37,500 of net income. So make sure you do your planning properly as to whether the Social Security and Medicare tax is more savings or more cost, or whether the excise tax is more savings or more cost to you. When it comes to our C corporations, they are their own individual entity and they report and pay their own federal income tax. They use a Form 1120 to report their federal income and pay their federal income tax. And they pay a tax at a rate of 21%. Shareholders are employees of the corporation and receive W-2s for their wages. Any distributions of profit should be reported to those shareholders on a Form 1099 DIV. In addition, that corporation will pay franchise tax and excise tax in Tennessee. So for our corporations, our expenses include the wages that we pay to our shareholders for services, reducing the amount of net income that we have to pay 21% federal tax on and 6.5% state tax on. Any dividends that are paid out are not deductions or expenses of the business, but rather payments of dividends and should be reported to the shareholders on a 1099 DIV. C corporations can also offer those benefits that we talked about before. The health insurance premiums that they pay on behalf of the shareholders are deductible expenses and considered tax-free fringe benefits if the appropriate plans are in place. Keep in mind that the Affordable Care Act does not allow you to discriminate with regards to health insurance. So as you think through whether you want to be a C corporation, make sure that health insurance premium or that health insurance policy is not discriminatory. The retirement plan contributions that are withheld from employees' checks are deductible by the corporation, as well as the company's match for those retirement plan contributions. So the effect on the individual is essentially the W-2 wages are reported as income. They don't have to report health insurance premiums that were paid as income, or they don't get to deduct it either. Nor do they include as income the retirement contribution, nor do they deduct it. So in our C corporation example, our revenues minus our expenses, minus our W-2 wages for the two working shareholders minus the taxes is a net income of $5,000. Each respective owner reports their $30,000 in wages, and the corporation reports and pays tax on the $5,000 of net income. In our investing partner and working partner scenario, we have wages paid out to the working partner, payroll taxes, and so $37,500 of net income is subjected to 21% federal income tax and 6.5% excise tax for a combined rate of 27.5%. The individual owners also receive a distribution of profit of $30,000 in the form of a 1099 DIV, thus reflecting a $30,000 wage for Partner A plus a $15,000 dividend for Partner A and a $15,000 dividend for Partner B. So between the two individuals, they report $60,000 of income, and the corporation reports $37,500 of income for a combined owner and entity taxable income of $97,500. All right, let's transition into your various tax filings that you'll be responsible for as a new business owner. Those will include your local tax filings, your state tax filings, your formation filings, and then additional federal tax filings. So in the first year you started your business, you obtained your business license. That generally signs you up for something called a tangible personal property tax return. And then each year you have to renew that county business and city business license. In Tennessee, we call it a gross receipts tax return. You're paying a tax on the gross receipts of the business. and you're paying it for both the city and the county if you're operating in the city. If you're operating in just the county, you would only have a county business license. In addition to that annual renewal of your city and county business licenses, you'll be filing and paying sales tax on a regular basis, perhaps liquor tax or hotel tax as well. But the sales tax filing frequency will be assigned to you when you register for your sales tax registration. You may have to file that monthly, quarterly, or annually. If you're an employer in Tennessee, you will be filing a state unemployment tax return on a quarterly basis. And each year, if you are a limited liability type entity, such as an LLC, corporation, or limited partnership, you will be also filing and paying a Tennessee franchise and excise tax. When it comes to state formations, you filed with the Secretary of State initially to obtain your LLC or corporate charter. Each year you have to renew that through what's called a Tennessee Corporate Annual Report. That's filed and the fee is paid with the Secretary of State on an annual basis. At the federal level, depending upon your entity type, you will be filing an individual Schedule C as a sole proprietor or single member LLC. As a partnership, you'll be filing a Form 1065 at the federal level, and the individual partners will report their respective part of that partnership income on Schedule E. If you're an S corporation, you'll be filing an 1120S, and the individual shareholders will be reporting their respective part of the net income on their Schedule E on their 1040. Or if you're operating as a C corporation, you will file a Form 1120. Each of these filing deadlines is different, and so you need to find out what the filing deadline is for those returns to make sure you file them timely. In addition, there are some other federal tax filings that you need to be aware of that you'll be responsible for when you're in a trade or business. If you pay anyone more than $600, you're required to issue them a 1099. This last year they changed the forms from a 1099 Miscellaneous to a 1099 NEC for those independent contractors, and retain the 1099 Miscellaneous for other types of payments. If you need more information about that, be sure to check out my other video on the 1099 NEC forms. So besides sending that to the individual person that you paid more than $600, you also need to send the Form 1096 transmittal statement and the copies of the 1099s to the Internal Revenue Service. Other federal tax filings include your payroll-related filings, your Forms W-2 and W-3 that are submitted to the Social Security Administration and to the individual employees on an annual basis, the Federal 940, which is your federal unemployment taxes that is filed on an annual basis, the Form 941, which reports your wages, federal income tax, and Social Security tax that have been withheld and the company owes on the payroll for each quarter. Be sure you pay attention to the notification you get from the IRS when you register with them, because they may, depending upon the information you include on that application, assign you an annual filing frequency, which is on a 944. You need to follow that filing frequency until they tell you otherwise. So if you don't have time to do it right now, when will you have time to do it over and do it correctly? Those are the thoughts I'll leave you as you think about what kind of entity you want to be and how you want to start your new business. And I wish you the best in your new business venture, and be sure you seek qualified advice for help working your way through some of these different choices that you need to make. Good luck.